Right friends, welcome back to Learning Space. This is Union Budget 2019-20, right? An overview. The budget presented by the Finance Minister Nirmala Sitharaman, I would like to discuss from three perspectives. First and the foremost is facts and figures. What exactly you understand by various facts and figures? What is the meaning and relevance of these facts and figures? Second, important takeouts from the budget speech and how they are relevant. Third important aspect is critical appraisal, pros and cons. I would like to discuss threadbare with regard to pros and cons. Friends, the discussion will revolve around these three aspects. Please listen till the end. This module constitutes around 1 hour, right? And these three aspects will be discussed threadbare. Right friends, before going ahead, most of you are well aware about various constitutional provisions as well as what is mentioned as per Fiscal Responsibility and Budget Management Act 2003, right? And budget is nothing but annual financial statement as per Article 112 of the Constitution. Most of you are well aware. Let us move ahead. Let us look at the facts and figures. What is the quantum of total expenditure? Total expenditure is around 28 lakh crores. What is the size of Indian GDP? If you look on nominal terms, the size of Indian GDP is 190 lakh crores. And our expenditure, as far as central government is concerned, total expenditure is around 28 lakh crores. Why I am mentioning this is when you are looking at expenditure for various programs, when you are looking at various receipts, you will have clear understanding, right? Total expenditure or total receipts are around 28 lakh crores of rupees, right? Out of which revenue receipts are around 20 lakh crores of rupees. Revenue receipts are around 20 lakh crores of rupees. Capital receipts are around 8 lakh crores of rupees. Out of which borrowings and other liabilities are 7 lakh crores of rupees. Right friends, out of this 28 lakh crores of expenditure, around 7 lakh crores, please listen carefully, out of this 28 lakh crores of expenditure, around 7 lakh crores is borrowings and other liabilities. What we call this fiscal deficit. Fiscal deficit is around 7 lakh crores out of total expenditure of 28 lakh crores. This is percentage of GDP. If you calculate, 3.3% of GDP is expected for 2019-20, right? And another important aspect is how the government will meet this 7 lakh crores of rupees. Government meets this 7 lakh crores of rupees through market borrowings, as well as accessing to public provident funds, as well as accessing to small saving schemes. We will look at it a short while from now. Friends, 7 lakh crores is fiscal deficit, out of which revenue deficit is around 5 lakh crores. What is the meaning of revenue deficit? You are borrowing money to spend for day-to-day regular expenditure. That is the meaning of revenue deficit. Friends, revenue deficit means your revenue receipts are not sufficient to take care of revenue expenditure. That means what is revenue expenditure? Revenue expenditure is nothing but pensions, salaries, day-to-day establishment expenditure, all these examples of revenue expenditure. Friends, so the significance of revenue deficit is you are borrowing money to spend on day-to-day activities. If you are borrowing money to purchase a house, to purchase a land, that is acceptable. But if you are borrowing money for day-to-day expenditure, that means for paying the house tax, for paying the grocery shop bills, for paying the telephone bills, all these things are not acceptable. So friends, why I have taken this example is to explain you about revenue deficit. That means your revenue receipts are not sufficient to take care of your revenue expenditure. That means you are borrowing money to spend on day-to-day activities. Borrowing money to construct expressway, to construct airport, to construct port, it is acceptable because in future it will generate returns. That's why borrowing money for capital expenditure is acceptable. But we are borrowing part of which is used for day-to-day expenditure. That is the meaning of revenue deficit. Revenue deficit should be brought down to zero, right? So friends, revenue deficit indicates that part of your borrowings are used for day-to-day expenditure. Effective revenue deficit, that means part of the revenue expenditure is for creation of capital assets, right? So if you subtract that, that means part of the money is used for creation of capital assets. If you subtract that, even then also effective revenue deficit is close to 3 lakh crores, right? Primary deficit, I am not going into that. Primary deficit is nothing but fiscal deficit minus interest payments, right? What is the importance of that matrix? I am not going into that, right friends? Most important is this revenue deficit, right? It should be wiped out. Otherwise what happens? You are borrowing money for day-to-day expenditure, right? Let us leave this discussion here and let us look at revenue receipts. We have seen here total receipts are around 28 lakh crores. Out of around 28 lakh crores, around 20 lakh crores are revenue receipts. Around 8 lakh crores are capital receipts. Let us look at them one by one. Revenue receipts. Out of revenue receipts, you can bifurcate them into tax revenue, non-tax revenue, right? This is tax revenue, this is non-tax revenue, both put together, that will become total revenue receipts. Let us look at tax revenue receipts. Friends, please don't forget the highest component is corporation tax. Corporation tax is around 7.5 lakh crores. Please don't forget total expenditure or total receipts are around 28 lakh crores. Please keep that in mind. Out of that, corporation tax is around 7.5 lakh crores of rupees, and this is the highest component. The second highest is GST. Please don't forget, this is taxes on income is the third highest. That is nothing but personal income tax, right? So these three are the major components. One is corporation tax, second is GST, third one is income tax. And friends, there are two other components. Don't forget union excise duties. Why union excise duties are coming into picture after the introduction of GST? Because of the reason certain things are not brought under GST. Still there are certain things like electricity, like petrol, like diesel, these are outside GST, right? So union excise duties are on those which are not brought under GST. Then what is customs duty? Basic customs duty is not subsumed under GST. So therefore, here some of the customs duties, please remember, some of the special customs duties are subsumed under GST, but basic customs duty is not subsumed under GST. So therefore, customs duty is there. So here total tax revenue is this much, and state's share as per Finance Commission recommendation, 42% of the shareable taxes that is to be shared with the states. Friends, the collection charges, then cess, surcharge. These three are not required to be shared with the states. Please remember, collection charges, cess, surcharge, these are not required to be shared with the states, right? And state share is around 8 lakh crores. After that, center's net tax revenue is around 16.5 lakh crores, right? So this is center's net tax revenue after devolution to the states. After that, this is non-tax revenue. This is not required to be shared with the states. Friends, here dividends and profits. This is one important component. What is this dividend and profit? Dividends and profits, these are from public sector enterprises, right? Public sector enterprises, there the profits, they will be shared with the center because center is the majority shareholder in public sector enterprises. Dividends, when the companies are performing well, they pay dividends. So friends, this is the major component of non-tax revenue for the center. Total around 3 lakh crores is the non-tax revenue. Please don't forget, this is not required to be shared with the states, right? And we have seen center's net tax revenue in the previous slide, and non-tax revenue which is not required to be shared with the states, and put together it is coming around 19.62 lakh crores. This is total revenue receipts, right? So total revenue receipts for the center are around 20 lakh crores of rupees, right? Then let us look at capital receipts. If you look at capital receipts, the most important aspect, please don't forget, disinvestment. If the share of the public sector undertaking is sold, if 5% is sold, if 10% is sold, that is minority stake sale. But if majority shareholding is sold, that is example of strategic disinvestment. Friends, both put together is 1,05,000 crores. So friends, this disinvestment that comes from selling the shares of the government in the public sector enterprises, please understand the difference. In the previous slide, we have seen dividends and profits by the public sector undertakings. That comes under non-tax revenue receipts. But if you see this disinvestment proceeds by selling the share, that comes under capital receipts. That means, for example, if you have a house, you are getting house rent every month. That is an example of non-tax revenue. And if you sold the house for 10 lakhs, and that 10 lakhs is example of capital receipt. That is the difference. Please understand. Right, friends? Here disinvestment is rupees 1,05,000 crores. Debt receipts, this is nothing but fiscal deficit. 3.3% of GDP we have already seen. And this includes borrowings and other liabilities. So friends, out of total 28 lakh crores of rupees, around 7 lakh crores of rupees are debt receipts, or you can say fiscal deficit, 3.3% of GDP. And if you include this, it is becoming 8 lakh crores. This is capital receipts. Friends, in the capital receipts, predominantly debt receipts are there, right? Because country like India resorts to deficit financing. The expectation is we borrow money to be used for some productive purpose. We borrow money for creating assets. Because of that, what happens? Future generations will be benefited when you create assets. That is the logic behind deficit financing. But the unfortunate aspect is part of the borrowings are used for day-to-day revenue expenditure. That is not acceptable. That's why revenue deficit must be brought to zero. Right, friends? Here, after learning about all these things, let us look at total receipts, total revenue receipts, capital receipts, put together total receipts. This is total expenditure. In a nutshell, our total expenditure is around 28 lakh crores of rupees, out of which 7 lakhs of crores is basically debt receipts, or you can say fiscal deficit. Having learnt all these things, let us look at important expenditure statistics. Some of them may be important. I would like to be brief on this, right? Out of the central government expenditure of around 28 lakh crores, let me repeat once again, total expenditure of center is 28 lakh crores of rupees. And friends, these three subsidies, food subsidy, fertilizer subsidy, petroleum subsidy, these three put together is around 3 lakh crores of rupees. Total expenditure is around 28 lakh crores of rupees, out of which 3 lakh crores of rupees is for this subsidies. Defense is another 3 lakh crores of rupees. that is excluding defense pensions. Agriculture, now it is 1.5 lakh crores of rupees. Why it is increased? It is increased because of PM Kisan. Please understand, rupees 6,000 transfer to the farming family, right? So government announced PM Kisan 6,000 rupees direct transfer to the farmers, right, every year in 3 installments. Because of that, this agriculture, this is increased to 1.5 lakh crores of rupees, right? Interest payments, it is around 6.6 lakh crores because of your previous borrowings. That means the debt is accumulated. Over that debt, you have to pay interest every year. So that is interest payments. It is around 6.6 lakh crores of rupees, right? Then core of the core schemes. If you look at central government expenditure, please don't forget core of the core schemes, out of which the major one is Mahatma Gandhi Narega. It is 60,000 crores of rupees. Please don't forget, as per the revised estimate of 2018-19, it is around 61,000 crores of rupees in comparison to the revised estimates for 2018-19. In fact, it is slightly reduced, though it is increased in comparison to budgetary estimates for 2018-19, but in comparison to revised estimates, it is reduced by around rupees 1,000 crores of rupees, right? Then core schemes, I mentioned some of the schemes. Please have a glance at them. Pradhan Mantri Awas Yojana, then Pradhan Mantri Gram Sadak Yojana. These are mentioned as core schemes. Pradhan Mantri Krishi Sinchai Yojana, right? Like that, number of core schemes are there. I have taken only few, and this some of the central sector schemes. I have taken some of the central sector schemes so as to explain you what are these central sector schemes. Please don't forget PM Asha central sector scheme. These subsidies, that means fertilizer subsidies, central sector schemes, interest subsidy for crop loans. For crop loans, government give 2% interest subsidy, and if they are paying in time, they will get 3% more subsidy. So friends, that is in fact interest subvention for the crop loans. Then this market intervention scheme and price support scheme, and PM Kisan, huge allocation of 75,000 crores of rupees for PM Kisan, right? That is direct income support to the bank accounts of the farmers. Like that, here just have a glance at it. Food subsidy to Food Corporation of India and other procurements, it puts together 1,84,000 crores of rupees, right? Direct benefit transfer, LPG connection, this is Ujjwala, right? Then let us look at how rupee comes from, right? And these are important from your exam perspective. If you look at how rupee comes from, we have already seen the highest component is this corporation tax, right? And then comes this goods and services tax, then comes income tax, right? And of course, borrowings and other liabilities make up 20 paise or 20%, right friends? The highest component is corporation tax. And how the rupee goes? Here if you see, state's share of taxes and duties, right? That is 23. Then comes this interest payments 18 paise. Like that, the things are mentioned here. This central sector schemes, then centrally sponsored schemes, pensions, subsidies, defense payments, all these things. Just have a glance at this slide, how the rupee comes, how the rupee goes, and here you can have a glance. The similar thing is mentioned in different paradigm. 23% goes to state's share of taxes and duties, right? And this is 21% corporate tax, how the rupee comes from. And friends, these are very important from your exam perspective. The deficit trends, here you see from 2011-12, if you look at the deficits, right, most important is this fiscal deficit and revenue deficit. Just have the glide path of this fiscal deficit from 5.9%, now it is 3.3% anticipated for 2019-20. Sometimes this glide path is important. Then the next one is deficit financing. As I have already told you, around 7 lakh crores is the fiscal deficit. Friends, if you look at the budgets for the past 3 years or so, here you see market borrowings from the market. They are almost stable. Here you see, they are almost stable at around 4.5 lakh crores of rupees. That means now the government is relying more on accessing small savings funds, right? So this is small savings funds. It is accessing to the tune of around 1.2 lakh crores of rupees. You see, this line is accessing small savings, and this is in fact public account deposits. This is provident funds. So therefore, here one important aspect is now the fiscal deficit is around 7 lakh crores of rupees, right? And in absolute terms, the fiscal deficit is increasing. Of course, as percentage of GDP, it is of course coming down from 3.4% to 3.3%, and the glide path also we have seen. Here you see it came down from 5.9% to 3.3%. But if you see in absolute terms, the fiscal deficit is at present around 7 lakh crores of rupees, but the government is maintaining almost same range of market borrowings. You see the market borrowings for 2017-18, these are the market borrowings for 2018-19, these are the market borrowings for 2019-20, and they are around 4.5 lakh crores of rupees. And government is relying more on this accessing small savings funds, as well as government is accessing public account deposits, as well as this provident funds. So therefore, the government is keeping almost the access to these market borrowings without much increase. It is relying more on these small savings as well as provident funds. This is one important change, please don't forget. And you may have a doubt, what are the advantages? What are the disadvantages because of that? One advantage I would like to tell you, as the market borrowings are kept at the same level, now the funds availability for the private sector is ensured. That means private sector will have sufficient funds for the borrowings from the market. Because of that, it prevents crowding out of private investment. Friends, the government's step of almost keeping the market borrowings at the same level, and it is accessing more and more from small savings and provident funds. What is the repercussion of it? The important aspect to note here is, because of that, it prevents crowding out of private investments. Very important point. It prevents crowding out of private investments, and it makes the money available for the private sector sufficient, right? So friends, the money available for the private sector will not be reduced. Because of that, it prevents crowding out of private investments. But what is the disadvantage? The disadvantage is, when they are accessing small savings provident funds, the cost of funds, that means the interest rate to be paid, is higher. It puts more interest burden on the center. Right friends, I told you two sides of the story. These are very important, right? And the next one, just have a glance at it. These are center's trend in the tax receipts. If you look at the trend in the tax receipts, please don't forget, after reaching this 12.1% as per the budgetary estimates of 2018-19, in fact, in the revised estimates, they were pruned down to 11.9. Now it came down to 11.7. Right friends? So here, this is very, very important thing. After reaching a peak of 12.1 as per the budget estimates of 2018-19, right? But after that, in the revised estimates of 2018-19, they were in fact reduced to 11.9% and now 11.7%. So this trajectory is also very important. Not only that, the trajectory of direct taxes and indirect taxes, this is also very important. Please don't forget. from your exam perspective, this trajectory is also very important, right friends? Then trend of capital expenditure. Here you see, if you look at the gross budgetary support, revised estimate for 2018-19, budget estimate for 2019-20, here you see in absolute terms, here there is not much increase, and we will do it in the critical appraisal. So friends, government is not in a position to spend more on its own for capital expenditure. And because of that, what is happening is it is relying more on this internal and extra budgetary resources, right? How they increased in recent times, just you see. That means borrowings by the public sector enterprises. This is one example of internal and extra budgetary resources. In fact, government on its own is not in a position to spend more for capital expenditure. We have already seen there is revenue deficit as far as government of India is concerned. So because of that, government is in fact relying more on internal and extra budgetary resources. Even that also in fact declined in comparison to 2018-19. When you look at 2019-20, probably government would like to give thrust to the private expenditure, or you can say private investment, right? And just have a glance at it. This is trend of major items of expenditure. Why I have taken this is there is not much increase for any of the other programs, right? It is nominal, it is expected because of inflation, because of real GDP growth. These are expected, these nominal increases are expected, but one striking change is as far as agriculture is concerned. In the agriculture, the expenditure increased enormously. The prime reason is PM Kisan, that is direct income support, right friends? This is vision for the next decade. Just have a glance at it. What is Government of India's vision for the next decade? And this concludes facts and figures part. Let us look at what are the important takeouts from Union Budget. Third part will be critical appraisal. So let us start with what are the important takeouts. Friends, the fiscal deficit is going to be 3.3% of GDP. It is slight reduction in comparison to the revised estimates for 2018-19. As per the revised estimates for 2018-19, it is at 3.4% and it is expected to reduce to 3.3%, right? So we have seen glide path a short while ago, how the fiscal deficit reduced during the past 8 to 9 years. Friends, 2018-19 we have seen the GDP growth rate of just 6.8%, the lowest in 5 years. And for 2019-20 it is expected to be 7%. Friends, another important aspect is disinvestment target. Disinvestment target is going to be 1,05,000 crores, but the important aspect is what should be the quality of disinvestment, because government is resorting to one public sector purchasing another public sector. So friends, under these circumstances, the quality of disinvestment is most important. Then second is Air India disinvestment is going to be reinitiated. Then the government will undertake strategic sale of public sector undertakings, because when you look at disinvestment, it involves minority stake sale and strategic sale. So the government says it will also involve strategic sale of public sector undertakings. And all of you are familiar with consolidation in the public sector banks, and similar consolidation will take place in other public sector undertakings also. Then most important point, please don't forget, the government is considering to retain public sector undertakings in government control, even though the stakeholding goes below 51%. What exactly you understand by it? Normally, the government majority control, or you can say the government control is normally ensured when the government shareholding is 51%. But what is the meaning of this? Meaning of this is in future, government may have 40%, LIC may have 11%. So therefore, overall 51%. Under those circumstances also, in future, government will look at ensuring government control when the government shareholding goes below 51%. Another important aspect is, in comparison to the revised estimates of 2018-19, direct taxes are budgeted to increase by around 17%, indirect taxes by around 15%. So therefore, some sort of realism is inbuilt into the budget. This is about macroeconomic perspective. Taxes front, 4-5 important points I would like to tell you. First and the foremost is PAN and Aadhaar. They will become interchangeable. This is highly significant because India has got more than 120 crore Aadhaar cards, whereas PAN cards are just around 42 crore. Under these circumstances, you can quote Aadhaar number to file income tax returns, most important. Then the next important aspect is this special additional excise duty by rupee 1, and the second one is this road and infrastructure cess, that is by rupee 1. That means petrol and diesel are going to become costlier by rupees 2, plus state VAT will be there, because state value added taxes are based on the value. So therefore, for the common man, petrol and diesel are going to cost more than rupees 2 as far as this budgetary announcement is concerned. That means petrol and diesel prices will increase by more than rupees 2 after this budget, right? And another important aspect is this road and infrastructure cess. It is increased to rupees 9. Previously, it was rupees 8, right? We have to look at state VAT, which is based on the total value. So therefore, as far as common man is concerned, petrol and diesel are going to cost more by more than rupees 2. Then third important aspect is the turnover limit of 25% tax. That means 25% corporate tax was there previously for the companies up to turnover of rupees 250 crore. Now it is extended to rupees 400 crore turnover. Because of that, government is going to lose revenue of rupees 4,000 crores a year. Then fourth important aspect is basic customs duty is increased on certain items. Right friends, this is to give thrust to Make in India, or you can say it is almost akin to import substitution. There are in fact proponents and opponents for this move. Some people say it makes the country's manufacturing ecosystem uncompetitive and the customers will lose the products at competitive prices. That means the customers will lose the opportunity to get the products at competitive prices. So therefore, if you see from these perspectives, there are opponents and proponents. As far as increase in basic customs duty is concerned, friends, increase in basic customs duty is basically to give thrust to Make in India initiative. Friends, for the high income people, that means here effective tax rates are increased. This is by way of surcharge. The persons whose annual taxable income is above rupees 2 crore to rupees 5 crore and above 5 crore, their effective taxation will increase by 3% and 7% respectively. That means rich are taxed more and it will generate rupees 12,000 crores a year. Another important aspect is it is increased as a surcharge. So therefore, it is not required to be shared with the states. Right friends, cess, surcharge, these are not required to be shared with the states. So the center is happy with that, but it goes against the cooperative federalism. When the center is increasing more and more cess and surcharge, it goes against cooperative federalism. Then it is proposed to increase customs duty on gold and other precious metals from 10% to 12.5%. Government is taking number of steps to control non-essential gold imports, but they are in the range of $33 billion. They only reduced marginally in 2018-19 by just 3% in comparison to previous year. Around $33 billion. These are gold imports. These are non-essential, right? So like that, there are number of other aspects are also there. Scheme of faceless electronic assessment, basically to reduce human interface. Then enhanced interest deduction up to 3.5 lakh rupees for purchase of affordable house. Additional deduction in the income tax as far as interest is concerned, right? So this is enhanced to 3.5 lakh rupees, right? So because so as to give thrust to the housing sector, especially affordable housing sector, these type of enhancements in the interest deduction, that means if you are purchasing affordable house and on the loan taken, you have to pay monthly interest, and for the entire year the interest exemption from income tax, you have to pay income tax if your income exceeds a certain limit, but from that taxable income this will be exempted. That means whatever interest is there when you purchase a affordable house by taking loan from a bank, then you are paying regular interest. So friends, that exemption is now increased to rupees 3.5 lakh. Then one more important aspect is Sabka Vishwas Legacy Dispute Resolution Scheme. Basically, there are number of disputes as far as excise duties, service taxes are concerned, right? So to fast track those disputes, to close those disputes, Sabka Vishwas Legacy Dispute Resolution Mechanism is going to be brought, right? Next one is on GST front. I would like to take few seconds. Taxpayers having annual turnover of less than rupees 5 crore can now file quarterly returns. Then fully automated GST refund module, so that GST refunds, especially when exporters are concerned, that can be fast tracked. Then the next one is an electronic invoice system is proposed, and ultimately it will eliminate the need for separate e-way bill, right friends? Further simplification of GST is on the anvil, right? Then the next one is on investments and business front. India's sovereign external debt to GDP, that means government borrowings externally in comparison to GDP, they are lesser than just 5%. Under these circumstances, government took a decision that government borrowing externally will increase. There are several advantages. When government borrowing externally increases, it sets a benchmark for interest, so that other businesses, whoever are borrowing through external commercial programs, or you can say external commercial borrowing programs, they can get money at lesser interest. So therefore, government borrowing from external front will be increased. Then minimum public shareholding in the listed companies. In the listed companies which are traded through the stock exchanges, at present, minimum public shareholding means the shareholding by persons like you and me, minimum is 25%, but now it is proposed to be increased to 35%. Why? Because when minimum shareholding is increased, then what happens? The liquidity will increase, right? Then there will be an action plan to deepen long-term bond market. Friends, India is lacking long-term bond market, and there is a need to give boost to the long-term bond market. In the lack of long-term bond market, due to the lack of development finance institutions, most of the infrastructure funding is being borne by the banking system. Banking system is bearing the infrastructure requirements as far as funding is concerned, but commercial banks have got their own limitations. It leads to asset liability mismatch. When you are funding to infrastructure, then they give returns in the long run, 20 years, 30 years, but bank deposits are for shorter duration. It leads to asset liability mismatch. Friends, to fund the infrastructure needs. There is a need for long-term bond market. That means the infrastructure companies will issue bonds and mobilize money from the market. So therefore, deepening of the long-term bond market is the need of the hour. Second is development of development finance institutions. Friends, if you look at Indian economic architecture, two things are missing badly. One is non-development of long-term bond market. Second is lack of development finance institutions. These two are essential. Probably government is in the process of developing these two. Then Credit Guarantee Enhancement Corporation will be set up. That means when the corporates are issuing bonds, they can mobilize money at lesser interest rates. That means cost of capital in technical parlance, that will be reduced. That means for infrastructure to mobilize lakhs of crores of rupees, what is important is you should mobilize money at lesser interest rates. That means the cost of capital must be reduced, right? So as to reduce the cost of capital, Credit Guarantee Enhancement Corporation is proposed in 2019-20. Then investment driven growth requires access to low cost capital, because this is essential. India plans to mobilize 100 lakh crores of investments during the next 5 years. That means India has to mobilize rupees 20 lakh crore every year, right? And for that you require the mobilization at lesser cost, lesser interest rate, that is known as lesser cost of capital, right? Then steps to promote startups. Startups will not be subject to any scrutiny with respect to valuation. That means funds raised by startups will not require any scrutiny by the IT department with regard to valuation. We have seen angel tax conundrum. Friends, all this will go away. Income tax cannot scrutinize the valuation of the startups because government thought it is inhibiting the growth of startups. So therefore, now government decided income tax department cannot look at the valuation of the shares purchased by the venture capitalists in the startup companies. That means if somebody is investing in startup company, the valuation of the shares are not to be scrutinized by the IT department. Big boost to the startup ecosystem. Then TV channel to be launched for promoting startups. Then social stock exchange, very important. There are several social enterprises. There are several voluntary organizations who want to serve the society. Friends, they have to mobilize money. For that purpose, social stock exchange, that is planned, very good. Then India will host global investors meet. Then banking sector. In fact, there are some positive signs now in the banking sector. Non-performing assets are started coming down. Very important aspect. Here, NPAs of commercial banks came down by rupees 1 lakh crore and rupees 70,000 crores in recapitalization of public sector banks, because certain capital adequacy ratio is to be maintained by the banks, and to maintain capital adequacy ratio, this money is essential, and because of this money what happens, they can push lending to various sectors, or you can say they can give more money to various sectors, right? Then record recovery of rupees 4 lakh crore in the last 4 years, very very important. This budget talks about record recovery of rupees 4 lakh crore in the last 4 years due to insolvency, bankruptcy code and other measures. Then friends, provision coverage ratio of the banking system is the highest in 7 years. All of you are familiar. Provisioning, right? That is essential. When bank loan becomes bad, the provisioning increases, right? So such type of provisioning coverage, that ratio reached the highest in 7 years. That means banking sector is now coming back on rails, you can say. Provision coverage ratio increased. NPA is reduced, more money is given by the center to promote lending to various sectors, right? So the government's thrust is to keep the banking sector on track. Then average recovery under various recovery regimes. Previously it was 23%. Friends, now it increased to 43%, primarily due to insolvency and bankruptcy code. That means if the loan has gone bad, if the loan value is rupees 100 crores, previously banks used to recover just 23 crores. Now that recovery increased to 43 crores. Right, friends, you can say banking sector is coming on track, right? Then on NBFCs, NBFCs are really in problems. For that, here on regulation front as well as on facilitating the mobilization of money by NBFCs, certain rules are eased. Friends, these points may be important from your mains perspective also, because NBFCs are really into problems. Government will provide one-time 6 months partial credit guarantee for the public sector banks. That means if the public sector banks purchase assets of NBFCs, NBFCs have given loans, and if those loans are taken over by banks for 6 months period, the government will give certain guarantee if there is loss. That means it facilitates liquidity into the NBFCs. That means public sector banks will take over the assets of NBFCs. That means NBFCs like DHFL, Muthoot Finance, I have taken only as an example, right? Friends, NBFCs have given loans, and now as a one-time measure to infuse liquidity into the system, because NBFCs are suffering from liquidity, to help infuse liquidity into the system, what the government has done is public sector banks take over those assets from NBFCs, take over those loans from NBFCs, and the government will give some guarantee. If you are making losses because of that, we will support you. And because of that, what happens? Banks will take over assets from NBFCs, and because of that, NBFCs will get some money. That is liquidity. They are suffering because of liquidity. Right, friends? This is the first step taken. Then second is RBI will get more powers to regulate NBFCs. Please don't forget, NBFCs are also known as shadow banks, and RBI will get more powers to regulate NBFCs. Then next most important change is housing finance companies, till now regulated by National Housing Bank. They will be regulated by Reserve Bank of India from now onwards. Very important. Housing finance companies are now regulated by National Housing Bank, and now the regulation will go to Reserve Bank of India, and National Housing Bank will continue to be refinancer and lender, but the regulation will be with Reserve Bank of India. Most important. Friends, housing finance companies, let me tell you once again, the refinancing mechanism that will be still with National Housing Bank, but the regulation will go to Reserve Bank of India from now onwards. Then RBI can supersede NBFC board. Very important. RBI can supersede NBFC board for a maximum period of 5 years, and an administrator can be appointed. That means if RBI feels NBFC board, any NBFC board is not functioning well, then RBI can supersede NBFC board for a maximum period of 5 years. That means more powers are given to Reserve Bank of India as far as NBFCs are concerned. Then it is proposed to permit investments made by FIIs, FPIs in debt securities. That means the mechanism pertaining to investments by foreign portfolio investors into the NBFCs is eased, so that they can get more money from foreign investors. One more important aspect is some tax incentives are provided to NBFCs at par with the banks. Then the budget has done away with debenture redemption reserve. That means when the NBFCs are issuing debentures to mobilize money, they have to keep certain money aside. That is debenture redemption reserve. That is taken out now. So therefore, more money will be available for their operations. Friends, these are the changes as far as NBFCs are concerned. In a nutshell, RBI is given more powers on NBFCs, right? Then steps to promote electric vehicles, just have a glance at it. GST rate on electric vehicles proposed to be lowered to 5% from 12%. Of course, the final decision is to be taken by GST Council. Additional income tax reduction of 1.5 lakh on interest on loans. You purchased some electric vehicle, you have taken loan, you are paying interest, and up to rupees 1.5 lakh rupees per annum, that 1.5 lakh rupees is exempted from paying income tax. Friends, this is to give boost to electric vehicles. Then there will be customs duty exemption for some e-vehicle parts. Customs duty is exempted, and most of you are familiar with the FAME 2, which is primarily to look at the demand incentives. Then steps to promote MSMEs. Rupees 350 crore is allocated for 2% interest subvention for MSMEs. Then most important aspect is payment platform for filing of bills for MSMEs. Friends, payment will be done on the platform itself so that you can track delays in payment. Then one more thing is this is Spurti. This will focus on bamboo, honey and khadi clusters, so that new clusters to bring 50,000 artisans into the economic value chain. That means for the products which they are making to create value addition. Then infrastructure front, just have a glance at it. Investment of rupees 50 lakh crore is planned during the next 10-12 years in building railway infrastructure, and most of it through the public-private partnership mode. Then 100 lakh crore infrastructure investments during the next 5 years, right? And Bharatmala phase 2, that is going to develop state road networks also. Then number of operational airports under Udan crossed 100. Jalmarg Vikas and Sagarmala, they will reduce the logistics costs, they reduce the transportation costs. Operating ratio in railways improved. That means previously to earn 100 rupees, you were spending 98 rupees. But now to earn 100 rupees, you are spending 95 rupees. So the operating ratio increased. Then Pradhan Mantri Gram Sadak Yojana completion target is in fact advanced from 2020 to 2019. Then 97% of targeted habitations have already been connected, and India is going to become $3 trillion economy during this year itself. Please don't forget. Then steps to promote digital payments. Just have a glance at it. You can easily understand TDS of 2% on cash withdrawals exceeding rupees 1 crore in a year from bank accounts. What are the reasons for it? There are two reasons behind it. One is to reduce the incidence of black money, because once it is withdrawn as cash, right, it may go towards developing the parallel economy, or you can say it may go into black economy. That is the first reason. Second important aspect is to promote the payments through the digital methods, whether it is a transfer from one account to other account, whether it is a transfer through various digital payment mechanisms, right? And there is another thing which you can go through it, but the most important is TDS of 2% on cash withdrawals exceeding rupees 1 crore per year from bank accounts. That is in fact a step which is desired. Then on agriculture sector, Pradhan Mantri Matsya Sampada Yojana thrust on zero budget natural farming, which is promoted by Subhash Palekar, and 10,000 new farmer producer organizations, basically to improve the bargaining power of the farmers. Then social sector, this is Pradhan Mantri Karam Yogi Man Dhan scheme that is targeting retail traders. 3 crore retail traders are going to be targeted. They require only self-declaration, Aadhaar numbers and bank accounts. Right friends, the retail traders and shopkeepers who have revenue of less than rupees 1.5 crore will be enlisted under this PM Karam Yogi Man Dhan scheme. That is nothing but pension scheme for the old age, please don't forget. Then for every verified woman SHG member having a Jan Dhan account, an overdraft of rupees 5,000 shall be allowed. So friends, SHG members, they are going to get overdraft of rupees 5,000. Then one woman in every SHG, they will be eligible up to rupees 1 lakh under Mudra. And please don't forget, 70% of beneficiaries under Mudra are women, right? And women SHG interest subvention program, it is extended to all the districts. Friends, you can go through them, right? And finally, other aspects, there is a proposal to establish National Research Foundation. Basically, this is to assimilate all research grants by different ministries independent of each other. That means they are working in silos. So therefore, so as to have coordination, National Research Foundation is planned. Then most important, by 2022, every single rural family will have electricity and clean cooking facility. Very, very important. The government promises by 2022, each and every house will have electricity and clean cooking facility in rural India. Then new Jal Shakti Mantralaya, the government goal is by 2024, all the rural households will have tap water. This is Jal Jeevan Mission, very important. By 2022, every single rural family will have not only electricity but clean cooking facility. By 2024, entire rural India, it will have tap water, right? By 2024 under Jal Jeevan Mission. Right friends, these are the important takeouts as far as Union Budget 2019-20 is concerned. And friends, for the next 10 minutes, let us look at critical appraisal. Friends, there are a number of positive aspects, but one important aspect is government relied more on the private sector to give thrust to the growth momentum. But private sector is bogged down by its own problems. So at this juncture, private sector may not be in a position to kickstart the growth momentum, right? So let us move on one by one. First one is center's fiscal deficit is budgeted at 3.3%. It is in the right tone so as to reach 3% by 2021. Second important aspect is there is a proposal to raise part of the government borrowings from the external markets. Because of that, there are a number of advantages. Here what happens? It enables the central government to borrow more cheaply, and at the same time, private firms will get more money from the domestic market. That means when the government is borrowing from external markets, more money will be available for the private sector to borrow from the domestic markets. Quite often people say, when government borrows more, it crowds out the private investment. But when the government decided to borrow more from the external markets, then it reduces crowding out for the private firms. So this is one positive aspect, right? Monetization of surplus land held by central public sector undertakings as well as departments for affordable housing and infrastructure development through public-private partnership is a welcome move. Not only that, once government takes this decision, it will also give thrust to other activities, or you can say other industries like cement industry, steel industry, right? So therefore, this is a welcome move. Monetization of surplus land held by central public sector undertakings departments. If you take cities like Hyderabad, public sector undertakings in the heart of the city hold thousands of acres. So therefore, part of the land can be monetized for affordable housing and infrastructure projects. It is the right move. Then the next one is, there is a one-time partial credit guarantee to banks for purchase of up to rupees 1 lakh crore of high quality assets of NBFCs. Friends, this will solve the liquidity problem of NBFCs. At present, NBFCs are suffering from liquidity. Then there will be no tax scrutiny on valuation for startups. Because of this, uncertainty which is prevailing in the startup ecosystem has gone away. So therefore, the impediment for the startups growth in the form of angel tax, that has gone away. Then measures for bringing NBFCs under the oversight of RBI are most welcome. We have seen now the Reserve Bank of India has got the powers to replace the NBFC board for 5 years. Not only that, housing finance companies are brought under RBI regulation. Friends, it will separate refinancing from regulation. Refinancing will be with the National Housing Bank and regulation will be with the Reserve Bank of India. Right friends, this is a welcome move. Then higher investment limits in government bonds for foreign portfolio investors. Definitely more money will flow in, right? But sometimes in the times of crisis, outflows may take place and it puts pressure on the rupee as well as current account deficit, and these issues are to be taken care of. Then increasing the public stock holding in the listed companies. When it is increased from 25% to 35%, what happens? It will have more stock for selling and buying, and it ensures liquidity, very, very important. Right? Then social exchange platform. Nowadays, there are several social enterprises and there are several voluntary organizations who want to raise funds for social cause. So therefore, social exchange platform under the regulatory framework of Securities and Exchange Board of India is planned. It is a welcome move. Then simplified KYC norms for FPIs that facilitate easy flow of money into the Indian stock market. Then government proposed more foreign direct investment in the insurance intermediaries as well as aviation sector, media, and it is most welcome. Allowing AA rated bonds as collateral. Because of that, what happens? They can put that bond as collateral and they can have access to money. So therefore, it helps raise more funds. Then the proposal to set up a committee to study the issue of development finance institutions is most welcome. We have seen a short while ago, Indian infrastructure sector, or you can say for mobilizing money for the long term, we are facing two problems. One is this is development finance institutions. India, development finance institutions. Second is deepening of the bond market. These two are the need of the hour. And now a committee to study the issue of development finance institutions is most welcome. Then another thing is government is moving towards a single identity card. Now Aadhaar is allowed. That means those who do not have PAN card, they can file income tax returns with Aadhaar. This is most welcome. Then introduction of faceless e-assessment of tax returns. This will reduce corruption. That means there will not be any human interface. Here the assessment of the tax returns will be done in an electronic way. That means faceless e-assessment of tax returns, that will reduce corruption. Then 2% tax deduction at source when withdrawals from bank accounts exceed rupees 1 crore in a year. This is most commendable measure. It has got two advantages. It will give thrust to the digital payments. Second important aspect is it will reduce cash payments. right? So friends, these two are the advantages, but one important aspect is sectors like construction. When one looks at sectors like construction, for the wage payments, they require huge cash, and this issue is to be sorted out. Right friends, these are the positive aspects and areas of concern in the budget. There is no mention of emphasis on doubling the farmers' real incomes by 2022. Government knows it is an uphill task and government abandoned it, it appears. Second important aspect, budget for this Department of Agriculture, Research and Education is just around 8,000 crores. It is almost at the same level in comparison to 2018-19. Friends, economic services, India spends only 0.37% of agriculture GDP on agriculture R&D, and developing countries needs at least 1%. But friends, there are no steps in that direction. Second important aspect, in the days of climate change, R&D in agriculture assumed huge significance. But friends, that is missing. Then the rate of growth of agriculture exports, if you see agriculture exports during the past 5 years, they are in fact negative. But under these circumstances, doubling the agri exports in 5 years is a highly difficult and Herculean task. Next point is, there is a deepening growth slowdown. We have seen 2018-19 growth rate of 6.8% is the slowest in 5 years, and the previous quarter growth rate is the slowest in 17 quarters. Under these circumstances, the focus on government investments is the need of the hour. That means to revive animal spirits, the need of the hour is government expenditure should be more. After that, it crowds in private investment. But government efforts are not in that direction, and government is relying more on the private sector. Right? So there are no measures of big growth push. Under these circumstances, big growth push is through either tax cuts or large expenditure programs. But government is not going for either of these. In fact, at present, $2.7 trillion economy, to reach $5 trillion economy by 24-25, it requires big push in the government investments. But there is no such measure in this budget. Then here, allowing for inflation rate of 4 to 5%, here what is required is real GDP growth rate of 8 to 9% to reach $5 trillion economy. To achieve this, investments is the key, and government left it to the private sector. And government is focusing more on rural areas, MSMEs, farmers, marginalized, and the task of propelling growth is left to the private sector. But private sector is not in a position to take up the mantle because of its own problems. Several companies are reeling under huge debts at this juncture. Right? At present, consumer food inflation is low in single digits and even negative in recent times. Previously, there were shortfalls as far as agricultural commodities are concerned. Now almost we reached the era of surplus. In the era of surplus, there is no need of Essential Commodities Act, and still several states are under Agricultural Produce Market Committee Acts or APMC Acts. Friends, there is no need for such laws in the present day surplus agriculture production, and it could have been better in the budget itself if the finance minister announced dismantling of these outdated laws. Right? This Essential Commodities Act, it may not be required in general. If the situation arises, government can go for some other measures. But having this Essential Commodities Act and restricting the farmers to certain mandis through the APMC Act, these are retrograde. So friends, because of that, what is happening is this warehousing sector, cold storage sector, the investments by the private sector are affected, and no clear-cut measures from the government in this direction. Then the budgeted figures, food subsidy, fertilizer subsidy, crop loan interest subvention schemes, then PM Kisan, all comes to around 3.5 lakh crores of rupees. Friends, these are only short-term measures. In the long term, what is important is R&D in agriculture, because climate change is imminent. Friends, measures in that direction are in fact absent. Whatever the measures government is taking, they are short-term measures, but long-term measures to revive agriculture sector are missing. Then government increased customs duty, basically to propel, or you can say to give thrust to Make in India, but it is a retrograde step if you look at it from the government reforms perspective. Friends, budget estimates for GST, if you see the original budget document for 2018-19, it says 7.43 lakh crores of rupees. In the revised estimate, it was brought down to 6.43 lakh crores, and now it is 6.63 lakh crores. That means the initial hopes of high GST realizations is lost. Then the final point is total expenditure of the central government rose from 12.7% of GDP to 13.2% of GDP in 2018-19, and now 13.1% of GDP. As far as the central government's expenditure is concerned, as percentage of GDP terms, there is a slight reduction in comparison to last year. So therefore, spending to kick-start the growth from government perspective is absent. Right friends, how to conclude? In spite of number of positive aspects, one major deficiency or drawback is the government relied on the private sector to give thrust to the growth momentum, but government on its own should spend more to put the economy on track to achieve the growth rates of 8% to 9%. That is what the final conclusion as far as this budget is concerned. Right friends, thanks for staying with Learning Space with lot of patience till the end of this module. Thank you.